Now coming to the actual preparation of bank reconciliation statement. How do we prepare the bank reconciliation statement? Now please remember, as far as the bank reconciliation statement is concerned, you have the cash book balance and you know the passbook balance. Either you can start from cash book balance plus minus all the differences and then finally arrive at the balance as per passbook. Or you start as per the balance of passbook and then do all the adjustments and then finally arrive at the balance as per cash book. Either way it is allowed. Now let us see, if you are starting from the balance as per cash book and let us assume that it is a normal balance. The normal balance meaning it is a debit balance in cash book, favorable balance. So receipts are more than payments. Now whenever you are starting from the normal balance as per cash book and there is any difference that makes passbook balance more than the cash book balance, then what you will do in the bank reconciliation statement is you will basically add that item. Why you will add that item? Because you are starting from cash book balance. That difference which you are talking about, that difference is making passbook balance more. Now you want to move from cash book balance to passbook balance, and that is why you will basically add in the cash book balance. Opposite case, when there is any difference because of which your passbook balance is lower as compared to cash book balance. So you are starting from cash book balance and you have found some difference. Let us take one example. There was some direct payment made by the bank. Electricity bill directly paid by the bank. So what has happened? When the bank has directly made the payment, the bank balance has gone down, but there is no entry in the cash book. So cash book balance has remained at the same level. Bank balance has gone down. You are starting from cash book balance. So what you will do, in order to arrive at passbook balance, you will basically reduce. So that is why you will basically reduce that amount from the normal balance as per cash book in the bank reconciliation statement. So this is what we do, starting from the normal balance as per cash book. Suppose we are starting from normal balance as per passbook. Then these treatments will be exactly opposite. So let us take, the example wherein, there was a difference because of which the cash book balance was more than the passbook balance. You are starting from passbook balance. Let us take an example wherein the check was received by us from some other party. The debtor gave us a check. So the moment the check is given to us, we will basically make the entry in the cash book. So what will happen to our cash book balance? Cash book balance will increase because we are showing it as a receipt. But the check is not cleared in the bank. So your passbook balance is at the same level, but because we have made the entry in the cash book, our cash book balance has increased. You are starting from passbook balance. So what you will do, in order to arrive at cash book balance, you will basically add. When there is a difference because of which cash book balance is lower as compared to passbook balance, you will basically then reduce it. Exactly opposite. Let us take the example. We have issued the check. Now if we have issued the check, we'll make, the entry on the payment side in the cash book. So our cash book balance will go down. But there is no entry in the passbook yet because the check is not presented for payment. So your passbook balance remains at the same level, but because you have recorded it in cash book, your cash book balance has gone down. You are starting from passbook balance, but you want to arrive at cash book balance. So you will basically reduce it to arrive at the cash book balance. So this is how we prepare the bank reconciliation statement. Now, so far we talked about the normal balances, but there can be overdraft also. So let us assume that, we are having overdraft in cash book, or rather overdraft as per cash book. Then how do we give the treatment for the differences? Now overdraft basically means negative balance, right? That means payments are more than the receipts. Now if we are already having an overdraft in the cash book and because of some difference, the passbook normal balance is higher as compared to the cash book balance. So in that case, what you will do is, suppose you have a negative balance in the cash book, what you need to remember is, if the passbook balance is more than the cash book balance, that means overdraft is lesser. Suppose for example, bank has deposited, dividend in our account. Then what will happen is basically the overdraft in the passbook will go down, correct? Because there is a receipt shown by the passbook. So if there is a receipt shown in the passbook, that means overdraft in the passbook will go down. But there is no corresponding entry in the cash book. So what will happen? You are starting from overdraft as per cash book, wherein there is no entry yet made. But in the passbook, there is a receipt shown, because of which the overdraft balance has gone down in the passbook. You are starting from here. So what you will have to do? You will have to reduce the amount to arrive at the overdraft as per passbook. Another difference because of which the passbook normal balance is lesser than cash book balance. Meaning, suppose bank has, charged interest on overdraft. We were not aware of it. So that is why there was no entry in the cash book. So cash book overdraft remains at the same level because there is no entry in the cash book. But because bank has charged interest on overdraft, bank's overdraft balance has further increased, right? We are starting from here and we want to go here. So you will basically add the difference. Opposite is the case when you start from overdraft as per passbook. The logic remains the same. Only thing is you are starting from overdraft as per passbook instead of overdraft as per cash book. Let us take the example. Difference that makes cash book balance more than passbook balance. We have received the check from a customer. So the moment the check is received, we will show it in the receipt. If we show it in the receipt, that means in the cash book, overdraft will go down, but there is no entry in the passbook. So passbook overdraft has remained at the same level. We want to arrive at cash book balance. So what you will do, basically from here, you will basically reduce that amount to arrive at the balance as per cash book. Similarly, opposite, difference that makes cash book balance lesser than passbook balance. So we have issued the check to somebody. Once we issue the check, we'll make the entry as payment in the cash book. The moment we show it as a payment in the cash book, our overdraft in cash book will further increase, right? So negative balance will further increase. So cash book overdraft has increased, but the check is not yet presented for payment. So passbook balance overdraft remains at the same level. You are starting from here and you want to go here. So what you will do, you will basically add to arrive at the overdraft as per cash book. So this is how we basically give the treatment when we prepare the bank reconciliation statement. The objective is basically to arrive at the balance as per the other book, starting from the balance as per the second book. These are all the ways the bank reconciliation statement is prepared. In reality, what we also do when we prepare the bank reconciliation statement is, after we identify all the reasons, you know now the reasons are basically of three categories. Timing differences, errors, and direct transactions in the bank. Now, it doesn't make sense actually to prepare a bank reconciliation statement with all these things in the reconciliation statement. The logical thing is basically when we know these are the reasons, then why not correct those things in the cash book, which is in our custody, right? So for example, if we realize that there is an error in the cash book, then what's the point in basically not correcting the cash book and showing it in the bank reconciliation statement? Obviously, somebody will logically say to us that correct that error in the cash book so that it doesn't appear in the reconciliation statement. So that is what typically we do whenever we prepare the bank reconciliation statement, and that is why it is called bank reconciliation statement based on adjusted cash book. So first we adjust the cash book to the extent possible, and then we prepare the bank reconciliation statement. Now when we do that, obviously what will happen? The number of items in the reconciliation statement will basically go down. What are the typical things that we adjust in the cash book before preparing BRS? First of all, errors in the cash book that we adjust because it is in our custody only and it is under our control to pass the entries. So we rectify the errors in the cash book. Then the direct transactions which are recorded by the bank. The moment we see the passbook and we sit down to prepare BRS, we get to know that okay, bank has charged interest on overdraft. Now if we get to know that the bank has charged interest on overdraft and this is not an error, then why not pass that entry in the cash book also, right? Instead of showing it as part of BRS. So what we do in that case, all these genuine transactions which are directly recorded by the bank, we basically update those in the cash book so that again these things will not appear in your BRS. Two things that we do not adjust are basically the timing differences, because timing differences are absolutely not under our control, right? The time will basically take care of these differences. So that is why as and when the differences disappear, that time basically we'll remove those items from the reconciliation statement. But till that time it will remain as reconciliation item. So timing differences we do not adjust. Similarly, errors in the passbook also we do not adjust. Why? Because passbook is not our property. Passbook is bank's property. Only bank can basically correct the entries or record the entries in the passbook. And that is why we cannot make any entry in the passbook. So timing differences and errors in the passbook, these two things are not recorded in adjusted cash book. So that is why these two things will continue to appear in your bank reconciliation statement until those are basically recorded properly. So obviously once we do this, then the BRS that is prepared is based on the new balance as per cash book. And in such case, basically the reconciliation items will basically be lesser because you are taking care of some of the differences already before preparing the bank reconciliation statement. First question, prepare bank reconciliation statement on 31st December 2010 for the following. They have given us the passbook overdraft balance 7,600, then the reconciliation items. So we are supposed to prepare BRS on 31st December 2010. So let us see bank reconciliation statement as on 31st December 2010. That will be your heading. So starting point is overdraft as per passbook 7,600. Now here they have given us overdraft as per passbook and we are supposed to arrive at the cash book balance. So we need to keep in mind this is about overdraft. So accordingly, the plus and minus signs will change. So checks deposited but not collected by bank, 8,560. Now, if the checks are deposited, obviously the first entry will be in cash book. So when the checks are deposited, the overdraft balance will come down in the cash book. Normal balance would have increased. Since we are talking about overdraft right now, overdraft balance will go down. So we are interested in calculating the cash book balance. So that is why now we need to deduct, because the entry is not yet made in the passbook because the checks are not cleared. So you will deduct 8,560. Okay. Incidental charges paid by bank but not recorded in cash book, 80 rupees. Now since these charges are paid by bank, obviously the entry will appear in your passbook and these are the charges. So that means the overdraft balance will increase. But since the entry is not made in cash book, it will be opposite sign. The overdraft balance will be lower in cash book. So again 80 rupees you will deduct. Incidental charges not recorded in cash book. Next, checks issued but not presented for payment, 3,400. Now when the checks are issued, again the entry will appear in your cash book. Since we are making payment, our overdraft balance in cash book will increase. So in your reconciliation, this entry is not appearing in your passbook yet. So your cash book overdraft balance will be higher as compared to passbook overdraft balance. So 3,400 we will add. So add checks issued but not yet presented for payment. Next, insurance premium paid by bank, not recorded in cash book. So as per standing instruction given, bank has paid the insurance premium. Since bank has paid the insurance premium, the entry will first appear in your passbook. And since it is a payment, overdraft balance in passbook will increase. But the entry is not yet made in cash book. So in cash book, it will be opposite sign, that is negative. So you will basically deduct. So insurance premium directly paid by the bank, 4,200 less. This is all less category. This is all add category. Then on 31st December, cash deposited in bank, 385. But the cashier debited the bank column with rupees 485 by mistake. The entry was correctly made in the passbook. So there was no error in passbook, but the error happened in cash book. And what is the error? The cashier by mistake has shown 100 rupees higher in the bank column. That means by 100 rupees, he has shown reduced overdraft in the cash book because he has shown higher deposit. That means the overdraft is lower. So overdraft is lower by 100 rupees in cash book. But this error was not there in passbook. That means in passbook it was shown correctly. So as compared to passbook, our overdraft balance in cash book will be lower by 100. So that is why you will deduct 100 rupees. Extra wrong debit in cash book. So these are the effects of all the different entries. So now 7,600, only one item in add plus 3,400. So you can actually show the total of these two together here also. And then all these four amounts to be deducted, that is 12,940. So your final balance will be, to show you the calculation, 7,600 plus 3,400 minus 12,940, 1,940. Now one care that you need to remember here, take here is, this is a negative amount that we are getting. So whenever you get a negative amount, that means whatever you have written here, at the end it will be exactly opposite. So here we started with overdraft balance. So now you will have a normal balance. If this was a normal balance, and you got a negative amount, that means this will become overdraft. So remember, it is exactly reverse. So now this will be normal balance, and ultimately we are arriving at cash book balance. So normal balance in cash book meaning debit balance in cash book. So debit balance in cash book now is 1,940. You can show the positive amount only because everywhere we are showing positive amounts, and since this is a debit balance in cash book, appropriate to show the positive amount. So 1,940 debit balance in cash book. It is not overdraft, it is your normal balance. Another question in BRS. On March 31, 2014, Amar had a balance of 57,000 as shown by his cash book. Now, when nothing is mentioned, you will assume it is a normal balance. From the following, prepare a bank reconciliation statement for him. These are the reconciliation items. Bank reconciliation statement as on 31st March 2014. Balance as per cash book. As I said, nothing is mentioned, so you will assume it is a normal balance. You don't need to write specifically debit balance or normal balance. When just balance is written, it is understood it is normal balance. So, balance as per cash book, 57,000. So, now we are moving from cash book to passbook and it is a normal balance, right? So whatever signs come in this column, those are relevant. Checks amounting to 22,500 had been deposited before this date, that is before 31st March. But of these, only 17,400 were cleared by the bank on this date. So that means the reconciliation will be not for 17,500 because 17,500 have appeared in both the books. So that means that will not be a reconciliation item. The reconciliation item will be the balance, that is 22,500 minus 17,500 because that is 5,000. Because the checks worth rupees 5,000 are deposited, but these are not yet cleared by the bank. So that means 5,000 will come in your reconciliation. Now, since 5,000 worth of checks were deposited in the bank, the entry was obviously made in the cash book. So your normal balance increased in cash book by 5,000, but these are not yet cleared in the bank. So that means the passbook sign is opposite. So you will deduct 5,000 rupees. So less checks deposited, but not yet cleared in the bank. Checks issued for 54,660, of which checks worth rupees 50,000 only were presented. Again, the same logic. Because checks worth rupees 50,000 have come in your cash book as well as passbook both. So that will not be a reconciliation item. The remaining checks, that is 4,660, that will come in your reconciliation because these are the checks which are issued. That means the normal balance in cash book has gone down because this is payment. But in passbook, these checks have not been presented. So passbook, it will be opposite sign. So in reconciliation, you will add 4,660. Checks issued but not yet presented for payment. Passbook shows a debit of rupees 1,000 in respect of charges for checkbook. So that means you will assume here the entry is not made in your cash book yet. So bank has directly debited 1,000 for checkbook. So since bank has directly debited, that means in passbook the normal balance has gone down, right? But entry is not made in cash book, so your passbook balance will be lower. So less 1,000 checkbook charges debited by bank. It was found that a check of 10,660 which was debited in the cash book was omitted to be banked. What it means is that we had received the check worth rupees 10,660 and it was debited in the cash book. That means in the cash book the balance has increased, but it was omitted to be banked. That means in the passbook the entry has not yet come. Therefore, your passbook balance is lower as compared to your cash book balance. So 10,660 passbook less check omitted to be banked though recorded in cash book. And the last, transferred rupees 4,000 from current account to fixed deposit account. Now please remember, the bank reconciliation statement is always done for current account because that's the account of the business. So it was transferred from current account to fixed deposit, which was not recorded in the cash book. So that means the entry has come in the passbook but not in the cash book. Now since the amount is transferred from current account, that means in passbook the current account balance has gone down, but in the passbook the entry is not made. So reverse sign in cash book. This sign is important. So you will deduct 4,000 in reconciliation. Transfer to FD not recorded in cash book. Okay, so all items covered. So 4,660, that's the only item in add, and all these four numbers put together 20,660. So your new balance will be now 57,000 plus 4,660 plus 20,660. So 41,000. This is a positive number only. That means we started with normal balance. So that means at the end also it will be a normal balance. So balance as per passbook now 41,000.